Hello, this is Jason Wenke, and thank you for checking out today's market update video. Today is Monday, July 22nd. It's about 11 o'clock a.m., so we have a few hours yet before the market closes today. It's been a couple weeks since my last update. It's been a busy summer here, so just after the 4th of July, I spent a lot of time with friends and family, but also busy working. So this is a bit overdue. But not a whole lot's happened in the financial markets other than good things. So it's always nice not to have to do updates and have things be working in our favors. In this case, I'm showing the S&P 500 daily chart. I use this often on my blog. And last time I made an update video, I'd drawn in these two green lines. I talked about how the market was trading in sort of a wedge pattern, and that at that time the market had not broken through it. My comments at that point were that, hey, there was good news because once you get into a wedge pattern, it usually sets the next trend. And if the market breaks out of the wedge to the upside, a new uptrend is likely to form. If it falls through the bottom of that wedge, a downtrend is starting to form. And obviously what's happened is about 10, 12 market days ago, the S&P 500 and most stock indexes broke through the top part of that wedge. It's continued to rally. In fact, I think there's been just one negative day in the last 10 or 12 trading days. So it's been a very positive run. Now, I should point out that where we are today is kind of at the top end of what may be a new channel. The blue horizontal lines that are going from the left to the right, lower left to upper right, that was the channel that we traded in for about 6 to 7 months, starting back last November and then ending in late May, early June. Now, where the market is today, if I'd extended this blue line all the way up here, you'd see that we're kind of hitting that same area. And then at the exact same time, the market's getting close to being in overbought territory. And we can see that by the top part of the chart here. When it gets above 70, you can barely see it, might look kind of small, but if you make this video full screen mode and make sure it's in high definition, you'll be able to read it. It says that right now the S&P's relative strength is 68.73. When it bumps above 70, which you can see it's done that a few times here, 3 times to be exact in the last 12 months, that always represents, at least in the short term, a little bit of a top. That doesn't mean the market's going to fall dramatically, but it becomes very normal for it to drop somewhere between 2 and 3%. It simply can't go up this much this quickly forever. So when we do see that relative strength get up in the 70 plus territory, that's when we start to anticipate that it will consolidate for a bit, maybe have a little bit of a pullback, and hopefully that pullback is small. And when it rallies again, we'll start to see the formation of a new channel where we can draw in these horizontal lines again and kind of see where the direction is headed. For now, things have been strong. It's largely been, ironically, because of bad news. The Fed's meeting back in May, we had Ben Bernanke, the chairman, talk about easing the quantitative, or tapering, excuse me, the quantitative easing program. So it felt like the economy was making some improvements, unemployment was drifting down, and the latest quantitative easing program would be tapered out maybe this year, late 2013 or early 2014. The markets didn't like that. That's what caused the sell-off, which was about a 7% drop from its peak in May. But interestingly, as a few not so good economic reports came out, the market rallied, and a lot of that has to do with the thought that, well, if the economy is not truly that strong, then the Fed will have no choice but to continue their easy money policies. And those easy money policies are good for stock investors because it helps keep interest rates low and money cheap. When you have a rapidly expanding money supply, it oftentimes will make the markets perform well. So it's an interesting sort of bit of irony there, but that's what has been happening. And we'll see what happens the rest of the summer. But for now, it doesn't look like there will be a huge summer sell-off. Here we are about halfway through, and the markets are very strong. So the analogy of selling in May then going away would not have paid off this year. In fact, quite the opposite. So I'll keep everybody updated. I think that I also am overdue to share our latest tactical asset allocation update, so I'll have a separate post likely before the end of this week just showing folks what we did this month. Until then, just so everyone knows we didn't sell all of our stocks. We actually increased our stock positions for July in our model, which probably would have made some folks nervous considering where June ended, but it's turned out to be the smart and right thing to do, which is part of the reason why we rely on mathematics to help make sure our judgment stays good and we don't let our emotions get the better of us. So I hope everybody's had a wonderful July so far. Continue to be safe and be well. I'll be back online with more posts later this week, and if anything changes, if we have a correction a little larger than what I think is coming, of course I'll let you know about that too. Take care and thanks again.